family office industry is about 30 years old. Sarah Hamilton of the Harris Bank in Chicago coined the term family office about 28 years ago and started a family office exchange for the Harris Bank. And since then, it's grown to over 12,000 family offices globally with well over $5 trillion under management. There's over 3,000 billionaires in the world. And of those billionaires, that's a fraction of ultra-high net worth individuals. There's approximately 85,000 ultra-high net worth individuals, of which about 13% have family offices globally. So it breaks down into about 5,000 family offices for North America, give or take a few hundred, 3,000 family offices in Asia Pacific, and 3,000 family offices in Europe. There's approximately 85,000 ultra-high net worth individuals. Average would be about 96 million each, but there's a bell curve from 20 million to billions. There's approximately 650 crypto funds, of which about 20% of all the new hedge funds this year are crypto funds. And they have several billion under management, the ones that raised money since last year. However, most of them are down significantly, about 53, 54% year to date in their crypto funds, except for those that are market neutral, and that's what family offices are looking for, is alpha generation over the S&P 500, over their traditional benchmarks. So what we've had is a severe disappointment, at least in the traditional crypto indices, of which there are several. The most recent is the Galaxy Index from Galaxy Digital. And there's a number of others that represent other segments of the crypto market. So the institutional investors, including ultra-high net worth individuals who have family institutions, like, say, Fidelity, one family, Abigail Johnson's family, are now dipping their toe into the water. Abigail Johnson is the most recent big headliner with 100 people at Fidelity Digital. The total is about 23 million investors with 6.4 trillion under management. So it's let's say they put 1% of that into crypto, that's going to be one of the largest players from the institutional market. So from the point of view of liquidity, even though we're at a low in the total liquidity, down to about 220 billion in the market cap of 2,400 crypto, down from close to 795 billion that peaked January 6th of this year, we have now the opportunity for family offices to jump into this, let's say, this liquidity gap. So we have now a very interesting panel representing different approaches to the market, different strategies, but all of them are seeking alpha and all of them are seeking diversification. And that's what I think we'll be talking about, is how do you get exposure to this market and what are the investment criteria. So with that, I'd like to introduce, or have them introduce themselves. Dennis from O'Neill Capital, Wayne from Founders Fund, and Jay from Synergy Wealth Group. So let's start with Dennis.
Hello, my name is Dennis O'Neill. I'm the CEO of O'Neill Capital Advisors. My background is 25 years of investment banking. Started two of the largest regional investment banks in Chicago, ran the SoftBank E2 Capital office in Chicago, raised a couple of billion dollars in early stage capital. I've spoken at over 50 venture capital private equity conferences, and now I am speaking on a regular basis at all the blockchain events as a thought leader and a cryptocurrency expert. And I guess we'll just do the introductions now, and then we'll jump into the into the details later.
Okay, my name is Jay Oberai. I'm the founder of Synergy Asset Management. We're a Swiss family office based out of Geneva. In fact, we're not a single family office. We're a multi-family office. We have 150 clients, $2.5 billion under management. We have traditional wealth management services that are typical Swiss in the sense that we're well allocated, diversified all around the world in various currencies. We've done very, very, very little in cryptos. But I do know that, and we have some of the highest returns in the world in terms of wealth management. We're at 15 to 16% IRRs for the last 18 years. However, I believe that that's going to compress. It's been a pretty nice world for the last 15 years, and I think that's going to change massively. So as that compresses, I need to find other opportunities and other ideas, and certainly one of them is this. I just hope that the move in Bitcoin that happens, if it does happen, which everyone's speaking about, it happens after there's some better regulatory environment and environment for family offices to put their clients' monies into.
My name is Huang. I put together a fund called Silverlink Aranya Founders Fund. It's not Founders Fund. We call it Founders Fund because the four of us, it's a family office, are all founders. I myself, I am with technical background. I started a company in 2003, a cybersecurity company. It was founded by the Skype co-founders, Toivo and John, and also well-known angels in Silicon Valley. We sold that company very well to a company called Proofpoint. Proofpoint's listed on NASDAQ, headquartered in Sunnyvale in the Bay Area. And so I spent the past 5 years as vice president of engineering for Proofpoint, during which time I put together this family fund to invest in startups with my spare time. It's just myself and my brother and two of my other friends, Andrew and John. In Andrew's background, he was head of Walmart procurement worldwide. He had $20 billion under his budget. He joined Alibaba very early. As Jack was closing his Series B, he got Andrew and Joe Tsai to join as board members to Ali, and then they founded Taobao together. So that's my friend's background. We did 7 deals, all equity, and these are the deals that I championed. I found and I championed. I like to do software deals, and I like to do seed rounds. So when these startups, it's their first time raising money. That's what I was passionate about. Andrew liked to do really big size deals. We did one together with Tutor ABC. They're a Taiwanese company. I come from Taiwan. We spent a week's time putting 15 million. Their post money was 1 billion. We were pretty happy about it because Taiwan doesn't have a lot of software unicorns. Last year, Andrew and John and Terry did a deal. The 3 of them put together 250 million into iQIYI. And they went public on NASDAQ, and they did pretty well with that. So that's what we do with this family fund. So all the way from very small deals in seed stage to very big deals, unicorns, pre-IPO rounds.
Yeah, I mean, for me, it's a little bit shocking to be here listening to everybody talk about the U.S. markets as like the be-all, end-all for cryptocurrencies, because I've been traveling throughout Asia and Europe, speaking at multiple different conferences, and I'm here to tell you that the U.S. market is trailing significantly than the rest of the world, especially in Asia. And you know, as far as, we had the boom and we had the bust. We had, the bad management teams with bad business plans getting hundreds of millions of dollars and blowing up, and then, having them, be the poster child for, the end of cryptocurrency. But I'm here to tell you, we are at the beginning of the beginning of the beginning of the beginning. I mean, less than 1% of the investment world has deployed capital into this market. Everything will be on blockchain within a couple of years. Every transaction, every recorded document will be on blockchain, and not all of it will be tied to cryptocurrencies. But I mean, in fact, a significant amount of it won't be tied to cryptocurrencies. But what we're seeing now is a flight to quality. We're seeing a flight to quality to management and to fund managers of crypto funds, because for the family offices, they're risk adverse. Regulatory risk is if they think there is in any way, shape, or form, they will not play. They don't want to be part of subpoenas and defending subpoenas in the United States for small deals. But internationally, it's a whole different world. I mean, here I would never do anything except an STO, and internationally, you can do utility tokens because they're not frowned upon as well, I mean, amongst the institutions as it is here. So the money is starting to flow. NASDAQ just announced that they're doing their own blockchain exchange. We have all these countries around the world, Malta, Liechtenstein, Estonia, Switzerland, France, Bermuda, Cayman, there's a flight to capital going to all these different jurisdictions simply because of gross negligence on the regulatory bodies, especially the SEC, not giving proper guidance and policy of how to be able to operate in the United States. So, I mean, this market is, I mean, you said 200 something billion dollars. The last numbers I seen, it was closer to $1 trillion. The numbers that I'm hearing forecasted by, you know, very sophisticated people is, you know, $22 trillion within the next 4 or 5 years. So we're expecting a boom in this market, but it's going to be not what we've seen in the past, to where that you know, every charlatan could, you know, raise money from wherever, you know, raising $300 million on a $1 billion market cap on an idea that, you know, would have maybe a 50-50 chance of actually making it.
I think this morning I heard someone say, in fact yesterday too, that you need to see the fall of the whole world before Bitcoin picks up. Everything needs to collapse for it to be exchanged. I think that's a bit of an exaggeration from whatever 30 years of my investment opportunities that I've had. Since we have diversified portfolios, I think Bitcoin should take up 1% of everyone's allocation, and maybe 2%, and maybe it goes to 5%, and maybe it goes up to 20%. It's going to be part of the alternatives, and the alternatives today are at 30%. Harvard endowment is at 30%, right, in alternatives. So it'll take a bigger piece of that. That's about it. And I think that'll be a much nicer and smoother way to deal with this whole thing.
Yeah, it's getting cleaned up. I mean, Yale, MIT, Harvard, I mean, they're all, I mean, you're starting to see the real money come into the market, sophisticated money come into the market, and it's just maturing, it's evolving, and it's starting to look like private equity and venture capital.
If I could just mention about Switzerland just very quickly, because it's important, is that for us, an STO is purely an equity investment. It is nothing else. It's just a way to get in. But what we own is actual equity of a company. So there's no difference. If you look at the Geneva government, it's forcing banks to accept cryptos. It's literally forcing them. It's the banks that are more worried. And it's not that they're worried because of regulatory reasons, it's because of execution reasons. They don't know how to do it. They don't want to get hacked. They don't want to get a bad name, a bad reputation, all of this. So if we could clean up that stuff, I think it'll happen pretty easily as far as the rest of the world is concerned.
I mean, but we have some really significant headwinds. I mean, when you're talking about replacing trillions of dollars in banks, investment banks, credit card companies, I mean, these are going to be the big losers in the market. So they're not going to go down without a fight. So they are blasting the press with every type of lie, slander, and insult they possibly can for cryptocurrencies. I mean, obviously we had the 2001 crash, we had the 2008 crash, to where that, you know, $20–30 trillion was lost in value. Not one person went to jail. Nobody lost their job. But if somebody does a bad ICO for $18 million, it's front page news on the Wall Street Journal, and they're just, I mean, I talked to, you know, some common people, and just they're like, is cryptocurrency still a thing? They think it's over, and it's just interesting because that we're dealing with the head forces of people that are going to be annihilated by this technology, at the same time that we have a very large uninformed, uneducated population of investors that don't understand it. And that's the biggest reason why the fund managers or the family offices are putting their money in fund managers opposed to doing direct deals because that they don't think they have enough sophistication to be able to vet each deal, one by one.
I think if you're an entrepreneur and you find it difficult to raise in a bear market today, then let's think about what we're doing, right? So for myself, I recently decided, well, I don't want to be a hobbyist investor, and I don't want to work forever at a public company. So I left recently, and in 2 months' time, I raised 5.5 million, and I recognize people say it's a bear market. So what we're doing as entrepreneurs is we're trying to build a business. We're trying to build a great company, right? And raising money is a means, but not the end. And so we ought to also consider professionals that have spent years helping to build companies. And by those professionals, I mean the venture capitalists. I see I see a lot of, we have a list of about 175 active token funds. Most of them are run by VCs. I see, lots of VCs still closing new funds that are still very, very actively investing because they just closed the fund. And I asked a lot of them, and I've been asking this with them about 6 months ago. They all did their proper hedging against Ether when they invested into tokens, right? Because you ought to do proper hedging to hedge out the Ether volatility so that as you gain more Ether, you're just making money for the fund, regardless of whether Ether is going up or down. And they all did that. They all went and shorted Ether, right? So bear market really doesn't affect them. Actually makes it a lot easier for them to get into the market. If you guys read the book The Big Short, it makes it a lot easier for professional funds to get into market when it's a bear market. So I do see two types of funds: professional early stage investment capitalists, and these are the VC funds. The investing equity, now they all have pure token funds that they have raised, and they're investing in token sales. They go by a traditional model. It's been, 50, 60 years of trial and error, and what we've found out as an industry, what works is you invest in stages, right? You see a good team, you give them some money to produce an MVP, and then when the MVP is out, if it's good, then you give them another round so that they can find PMF, and then when they found PMF, then you give them a big round, you help them blast it out of the water and really scale up this thing, right? We have not seen a model where in a seed round without an MVP, just an idea and a team, you give them a few $100 million, and that's gonna work. It's an unproven model. But the traditional model is proven to work. And that model is very active right now. It is not a bear market for them. The other model, and these are the token funds are not run by early stage investors. A lot of them funded by wealthy individuals. And a lot of them, when I asked them 6 months ago, 8 months ago, did you guys do your hedging? None of them did. And so when Ether went down, all of them lost money. It doesn't matter how much Ether they made, right? It's just, they have no theory, they have no system, they have no methodology. And so I do worry about this type of funds. I do see the potential for them to lose a lot of money and become quite inactive during a bear market.
So let me ask the panel, there's two different types of funds, crypto infrastructure funds, blockchain infrastructure, DLT funds, that are building out generally vertical marketplaces or vertical market tools. And those are 10-year lockups, those funds in general. And then there's these 1 to 2 year lockup funds, which are liquid crypto, which are down about 53% through the end of September. And perhaps we're going to have a turning point and shift toward stable security tokens. In most of those funds allow for both utility and security tokens. And I believe that most of them will pivot to security tokens as that market gets developed and more liquid with as it was pointed out yesterday, over 20 security token exchanges to provide liquidity over the next 6 to 12 months. So given those two types of funds, what do you think family offices prefer?
For the family offices that I deal with, it's a security token. Regulatory risk is just too much for them to stomach. I mean, they'll stay away from it. I mean, it would be very, very hard for them to do a utility token. Most of them that I'm looking at is that first, second, third, fourth, fifth is management. They want to see somebody with a track record of success, somebody on the team that's been able to scale a deal in the past, and then it goes to you know, where the technology is developed. I mean, do you have an MVP? How close are you to it? I mean, typically the family offices that I deal with, they want to see a product, service, or a platform that has actually been finished. If it's not finished, it has to be very, very close. It's got to have a real case for blockchain. It has to, valuation is always an issue for them. And they like to see that, you know, they've raised, you know, $500,000 to a couple $1 million, and they like to see how they, how they deployed the money. Did they spend all their money marketing their ICO, going all around the country, or did they actually spend the money, you know, scaling the actual project itself? So, but most of the money that I'm seeing, going into these markets, I mean, it's coming out of Asia, it's coming out of Russia, it's coming out of the Ukraine, Abu Dhabi, Dubai. The United States is a big lagger in this market, and probably the most critical piece of this whole puzzle is that do you have a lead institutional investor? If you have a lead institutional investor, they'll line up behind them very, very easily, but it's hard to find somebody that's willing to put their name on the line, that they've done the due diligence, and they're willing to lead the deal.
To answer your question, will family offices invest in 10-year funds, closed-end funds, or invest in short-term funds? They invest in both. The reality is that we know that if we invest in private equity funds which are closed for 10 years, our IRRs are going to be higher, so we're willing to take that risk. So it's going to be the same as a traditional. I don't think there's any difference in that.
The Sharpe ratio is not the same. It's a much more volatile sector.
Right, at this point it is, of course, but that's the whole point of utility versus security. I differ in one point versus everyone else since this morning, which is that I don't think it's only a regulatory issue as far as family offices investing in a utility versus or a security. The fact is that utility, for me, I can't evaluate it. How do you evaluate what a utility token should be priced at, depending on demand for a certain project, right? So if it's going to help you in a project, if the price of the utility token goes up too much, it's maybe not worth buying the utility to do something in that project. So for me, there's a cap for every utility token. The way it goes berserk in pricing upwards or downwards is too much. For us, it's much easier to price a security token because it's based fundamentally on the business, and we know what that business could potentially make, yes, up or down.
So
right?
Have you seen security tokens backed by diamonds, real estate, art, and other types of assets like precious metals? And what do you think of these different, let's say, underlying assets from the point of view that you just discussed, the ease of valuation, the transparency, but also what about the smart contract? Is there a risk in cybersecurity? Is there a risk in the execution of the smart contract to access the underlying commodity or real estate in the event of illiquidity on a public exchange?
Yeah, absolutely. That's the issue. The concepts are wonderful. They're beautiful concepts. But the practicality of it doesn't work. Second of all, there is no exchange, right? So you can't really sell them. So there's a liquidity issue on top of it, and obviously a security issue. So all those are going to be ones that affect it. But the concepts themselves are wonderful.
I found more success to do this type of communication with family offices using the concept of security tokens. When this is way before STOs were out. Because to me, like, what are the instruments? What are we buying into? Are we buying into debt? Are we buying into venture debt? Are we buying into rights to royalty, rights to dividend without voting rights? Are we buying into equity, right? Are we buying into commodity? I don't feel that blockchain or cryptocurrencies has created another type of instrument. It must, any type of utility, security token, whatever you call it, must represent some type of these instruments. And the family offices are already very familiar with these instruments. So if you use your language, it's going to make things easier. That's my experience.
Can I just bring up some interesting
Please.
point?
Yeah, we have about 3 minutes left.
Okay, sorry, very, very quickly. We're doing a hotel deal in Germany. 13 hotels, Hilton, signed up. We've got the land lease. We've got the operator. We've got everything. It's a $150 million deal. We'd rather invest it ourselves with our clients and then do a security token and find it and sell it off to clients ultimately. So what we're selling is a security token of actually something that really exists and there provides some kind of return. So we're doing it the opposite way.
And
Yeah, I mean, real estate's easy to do. I mean, obviously you can value real estate, but when you start going into art, diamonds, and other esoteric assets, I mean that's way too shady for the people that I deal with. But at the end of the day, I mean, it's either you believe in this vision of blockchain to where I believe that every single transaction, every single piece of recorded document will be encapsulated in a smart contract in blockchain, and that this market is going to significantly grow from close to $1 trillion to $22 trillion in 4 to 5 years. Day-to-day pricing is, looking at Bitcoin every day or whatever the other pricing is. In my mind, it's a form of mental masturbation. It absolutely doesn't matter in any way, shape, or form. It's either you believe in the vision, this is going to change the world. I think it's a mathematical fact that it's going to happen. And for the larger corporations, I mean, we're getting a very, very slow adoption rate. But once we start seeing one corporation do it and they end up with a huge competitive advantage, then you're going to see the gold rush. And then you're going to see every other competitor in the space try to catch up to compete, because obviously if you have a system that's cheaper, faster, safer, more secure, it's going to give you an immense competitive advantage. And once that happens in each industry, it's going to be a gold rush.
pass it to Wayne. So we're going to wrap up in 1 minute. Wayne, do you have 30 seconds or more to give us an overall conclusion or reaction to this?
So I think I wouldn't be discouraged about a bear market because I do see a lot of funds active. You just have to know if you're trying to raise, you have to know which funds to work with. And I think Dennis brought up a really good point. The lead investor is always the key. You have to find that lead first. And so some investors don't like to lead or has never led. So you should spend your time with the lead investors first. As when the lead's out, then everything's so much easier.
So I'd like to conclude with a few remarks and maybe 1 or 2 questions. So the market is bifurcating into US and non-US. There's a lot of jurisdictions offshore that are launching security token exchanges, and that's going to give a lot of visibility. But it's family offices want to invest usually pre-liquidity when it's still private, and then get the liquidity bounce and sell to the greater fool in the public market. So do you have a question?
Jen Grayson, I'm the founder of GoFo, which is the Airbnb for office space. And I also have a blockchain sisterhood, which is a group of over 40 women founders in blockchain. And we've seen a lot of disparity in the space where we know that even traditional VC money, like 2% of that is going to female founders. We don't know what we don't know. So what are you seeing from the men that women don't ask, need to start asking? What can we do to kind of change that disparity so that we can see better numbers?
30 seconds, then Wayne.
I think like, for example, I had a good friend, Chen Zi. She used to be a Forrester analyst, a researcher, and so we worked a lot with her. I understood that she became a venture capitalist and she raised a good fund. So when I decided to do my startup, I wanted to reach out to her. As I looked her up, and I found out her fund only invests in female entrepreneurs. So I'm disqualified to pitch to my friend. But then I started to Google, and I saw a lot of such funds. So maybe that's something that you can look into.
I'd suggest to everyone, if you have time, to Google the top 100 women in blockchain, and you'll see a lot of great rising stars in our industry. You have a concluding remark?
I don't
Yeah,
see
we
the.
have to wrap it up.
Sorry. You wanna-
All I can say is that, as a quote from Mark Twain, when a gold rush breaks out, it's good to be in the pick and shovel business.
And Jay, do you have a concluding remark?
No, I just think that when we're evaluating investment opportunities, I don't think we really look at it in terms of male or female. So just be yourself. I mean, just show that passion.
Right. And under promise, over deliver. So thank you very much, and look forward to seeing you next time. Thank you.